I wanted to spend a few minutes talking about understanding wealth creation and giving you a few basic tips that have worked for me. I'm now 64 and I have created considerable wealth. But when I was much younger and starting out, even though I had a great job, I had been to the best colleges, I had a fair amount of anxiety around wealth creation, and that anxiety was very unfounded. So if you understand the basics of wealth creation, I think anyone can create wealth and should not have much anxiety about doing that. So with that, let's get started. So I think the first thing one needs to understand is real return. So that is your return after inflation. So if your real rate of return after inflation is 10%, then in today's money, your wealth in 50 years will grow 117 times. So if you start out with just 1 lakh of rupees, you will end up with 1.17 crores of rupees in today's money, which is a lot of money and quite adequate for most people who can just start out with 1 lakh right now. So this is important to understand. The other is that if you had a real return of -1%, as quite a few people do, because they do not invest in equity, they invest in or real estate or some other kind of instrument like your own startup or maybe crypto or something which gives a significant real return or could give that, then you could end up with a -1% real return, which would destroy 40% of your wealth. So if you started out with 1 lakh, you would get left with 40,000. Now, of course, one other thing that you have to understand that in terms of your real return is that you need to control your savings and spending. Because if you spend a lot and save very little, then the chances of your getting a real return will reduce. So if you have managed your savings and you are spending wisely, enjoying life, but still maintaining a balance between spending and investing, then you can get wealthy slowly. For most average people, index investing is a very good idea. And the two extremes, one of being stuck in fixed deposits, and I almost call this a disorder because there are so many better alternatives to fixed deposits which exist, and I'll leave you to research those. But just know that today, if you're even putting 1 rupee in a fixed deposit, you are probably suffering from a disorder. The other extreme is the get rich quick disorder. So if you take prudent risk in certain things like your own business, like investing in startups, or if you think you understand the next big thing, maybe making the right investment in crypto or something, or if you're really lucky, maybe you buy a lottery ticket and you win a big lottery. So these are the sort of get rich quick things. I call this a disorder because if you kind of keep focusing on getting rich quick, then, and I'm not saying that you shouldn't, maybe you take part of your wealth and try and get rich quick. Nothing wrong with that. But if you just focus on that and you forget about managing your spending, your investments, and participating in index investing and getting wealthy slowly, then getting rich quick could be a disorder. Then another thing that you should focus on is very good housekeeping. So you should be able to track your wealth and monitor it against, say, an index and see how you're doing. Because if you are really good at trading or some stock picking yourself and things like that, then you should be doing significantly better than the index. But if you're not, then this tracking will help you know that, and you will avoid the pitfalls of wealth destruction and create wealth optimally. If you happen to create a significant amount of wealth, then you should not forget to enjoy it, because otherwise, what are you creating this wealth for? You entered the world with nothing and you will leave with nothing. So if you do not enjoy your wealth, then and keep trying to create more and more wealth and create more stress, then you are probably doing something which is suboptimal. The other thing that you should do is that you should consider transferring your wealth wisely, whether it is to society or to your next generation. It needs to be done in a very thoughtful manner. The last thing that I'll end with is investing in yourself. So you can invest in your mind, and there are lots and lots of ways of doing that. And you can invest in your body. That is your health. And again, there are lots of ways of doing it. But if you focus on that, think about it consciously, ask around, and find what works for you, then wealth will be automatic. So thank you very much for watching this video, and I hope you found something useful in it.
Good evening, everybody. It's my pleasure to welcome Sanjay Bhargava, my batchmate from IIM Ahmedabad, for this evening on discussions related to creating wealth. Sanjay has had a very distinguished career, as part of which he has worked many long years with Citibank, both in Asia Pacific and in the US. He has been part of the founding team that started PayPal, and after leaving PayPal, he has been independently creating wealth for himself for a long time. In 2004, he returned back to India and decided to focus on giving back to society. And he has taken many initiatives in that regard. In that process, we have also taken the opportunity to call him and be with us this evening to share some of his insights on the way he created wealth and answer some questions which have been put forward to him. Okay, over to you, Sanjay.
Yeah, thanks, Avnash, for having me. Just a small correction. I was in IIT Mumbai, not IIT Kanpur, but that's a minor thing. But anyway, you know, I thought we'll get started, and I hope we'll have an interesting and interactive session. You know, and kind of different from other sessions where everybody is telling you, you know, which stock you should invest in or what, et cetera, et cetera. So what I wanted to tell you very quickly in a few minutes, maybe 5-10 minutes, is what worked for me in wealth creation. And I've tried to make it generic because there are so many paths to wealth creation and everybody has to find their own path. But still, I mean, it is useful to see, you know, other successful paths because some of it you could adapt to your own path. So that is one. The other thing is that anything that I say here is general advice. It's not specific. I'm not a registered investment advisor. So if I end up talking about some stocks or something or the other, or options or fixed deposits or whatever, you know, just take this as general advice and not as advice given by your investment advisor. Okay, so with that, let me start with the few generic things that work for me. So the first part of my journey when I joined Citibank was that I ended up working very hard and very smart in a way. So smart and hard work helped me create a very successful business for Citibank way back in 1985 to 1989. And because of that, I kind of got recognized and I got selected for the international staff of Citibank and then got posted to Thailand and then to New York. So I think this is something that especially for the younger people, and maybe it applies generally, is that, generally if you work hard and you work smart, that is one of the things that is very necessary for wealth creation. The second thing that worked for me was this thing of building optionality. So by that, what I mean is that whatever my level of income was, I was fond of living well, but living minimally and not wasting money. So I never wanted to keep up with the Joneses. So like if I went to the US and I bought a car, it wasn't a Lexus. It was a Toyota Corolla initially till I established my insurance track record and so on and so forth. And later on, of course, I did buy a Lexus and all that kind of stuff. But even the conventional wisdom was when you buy a house in the US, you want to buy the maximum house that you can buy. Because then your gains may be more because you're using leverage. But I kind of wanted to control my expenditures and have savings so that I did not become a slave to the Citibank income. So by the time I reached 40, I had built a considerable nest egg. So I had reasonable financial independence. And I was not a slave to my Citibank income. Now, this was very important, and this is what I mean by building optionality. So I could take the risk of leaving Citibank, which was very pushy, and joining a startup, which at that time was called X.com, and worked closely with Elon Musk. And then ultimately it became PayPal and ended up doing quite well. And basically enabled me to stop working and focus on whatever else I wanted to do, including managing my money. So that has been my journey. Now, when I also joined PayPal, the last thing I want to say on this is that I always had a plan B. So the plan B was that if PayPal doesn't work, I would get back into a corporate career, because at that time I was 42. So probably with the internet experience, this and the other, I could get back into a corporate career. So I wasn't into just taking a blind risk in that. So after that, once I had created this sort of financial independence, so the key thing that I found, because I kind of more or less retired at around 43, 44. And by retired, I meant that I could do what I wanted. But it very soon became evident to me that, if you live a life without purpose, then this can be very boring. You may have all the money, but, you need to have a purpose. And you also need to enjoy yourself. So that is what I've been working towards in the last 15, 20 years. And I don't say that I've, completed the task. But over the time, I have found that I've become more and more comfortable. And because I've had a lot of time and tried out various things, made a few mistakes, I think I could basically answer some of the questions that you have. Again, with the caveat that you have to find your own way and not rely on what I say or others say. So with that, Avinash, do you have any questions on this, or how do you want to run this?
Yeah, okay. So let me explain to everybody how we are going to do this. Over the last couple of days, we have got numerous questions which have been in response to the survey form or the RSVP which was sent out earlier today. So what I've done is I've grouped them together by the interest type, and we will go through the questions in that form. The groupings are asset allocation, mutual funds, new generation assets, and planning. Planning being perhaps one of the most important parts, then real estate, retirement, and risk management. So all of these are extremely important subjects as far as wealth management is concerned. And so therefore I'll straight away dive in and anonymously indicate the questions, because some of the questions do give some personal details, so it is better to keep them nameless. So the first one about allocation is, now I am 42 years old, I have parental property and steady income. Does it make sense to invest in another house which may accrue rental income over investment in equity related instruments? So he's comparing rental income with equity related instruments.
Okay, so yeah, that's a great question. So let me try and answer that. I personally believe in a very asset light model. Between me and my immediate family, that is my son and so on and so forth, we own only one property, and that is in Santa Monica in the US. We kind of rent. Because especially in India, the rental yield is very, very low. And it's a big hassle owning property, like in terms of just the management of the property. And then if you want to buy a property and sell a property, and if you just do the math, that you'll find that if you leave aside the emotional reasons for owning a property, property as an investment is not something that makes a lot of sense. And I'll just explain this with a very simple example, where if you have a property of 1 crore and, you could make 10%, then in effect, and let's say you're staying in that property, your imputed rent is going to be 10 lakhs a year. And if the property is worth, say, 30 crores or whatever, which some of my friends have, then, the numbers become quite obscene. So that was what I would say, is that the advantage of having equities and stuff like that is that they're very liquid, and especially things like the indexes. If you compare equities as an asset class with real estate as an asset class, you will probably find that equities as an asset class in the long run do better than real estate as an asset class.
Okay. Would you say that rental income does not stay in pace with inflation as compared to equities?
Yeah, so that is there. But so this question on generating income, because I think this is a question that I also struggle with. And I think a lot of people who retire because they no longer have a salary income. So a lot of people struggle with this, saying, how do I replace my salary income? And this is something that I finally realized that, look, if I make a basket of investments where I invest in safe money, and I can talk a little bit about safe money, what that means and what you should do with it, and I have, say, risky money, and I have very simple, just two things, like these overnight funds and index funds, and I just do that, then I can withdraw money at any time. So as long as I don't want, because a lot of people try and invest in dividend paying stocks, or they invest in monthly fixed income scheme, or an annuity or something which will kind of give them a steady income over time, because they are not very comfortable dealing with volatility, dealing with withdrawal whenever you need. But this is again something that I would like all of you to study and see that that there are many better alternatives if you can deal with this volatility and structure your asset allocation. And I know we're going to talk about asset allocation later. So basically, if you want to keep up with inflation, then things like fixed deposits, fixed income instruments, bonds, and a whole bunch of these are not going to beat inflation in a significant way. the only way you can beat inflation in a significant way is going to be by getting into either equities or real estate or Bitcoin or some other kind of things. So that is, and equities have the advantage that you have inflation, plus you have growth, plus you have cherry picking, because somebody who's managing the index is cherry picking stocks for you. So they're probably doing better than the economy as a whole. And very importantly, you have liquidity, right? So you have all these things which are there in this thing. So that's why you can use equities, and you can manage your income needs with equities. One of the more advanced things that I've started doing is that I use covered calls and cash secured puts to generate income. But again, you can start off slowly trying to do all this, because you don't need to rush into it. There's a long time. It took me a very long time to reach the point where I am at now, where I think I'm quite comfortable, where I have a fair amount of capital appreciation, a good asset allocation, a good amount of income, and I manage my taxes, and I manage my Indian portfolio, and I manage my US portfolio.
Okay, so it appears that here in India, in Delhi, you're not living in your own house. It's a rented house. So at the back of your mind, you've never had a sense of insecurity, which typically Indian families have, कि घर अपना नहीं है, तो कभी ना कभी तो we will be without a roof. So has that never been a concern with you or any of your family?
No, it was. My wife, in fact, forced me to buy a home in Bangalore against my objections, which finally, after she understood, and we spent a lot of time on talking about this. So then she also understood that, if you have a fair amount of money and liquidity, you can always buy a home if you so need it, or you can move into a senior living facility, where there are very many different structures, which are quite nice. And you then retain the flexibility, and you do not have to manage homes in different places. So yes, we managed to get over that insecurity. But one thing which helped was that my landlord in Delhi is my mother-in-law. So she's not going to kick me out. So
Okay, so right. Okay, so closing the question which was originally asked very clearly, it may not make sense to invest in another house and use rental income. It may be better to look at higher earning instruments which possibly are equity related. Okay,
Yeah.
So now the next question which comes straight away is that is it a good time to use mutual funds as a method to invest into equity, or do it through a basket of stocks which you follow either through the index or through the options such as small case, which you and we have talked many times?
Yeah, so I think the way I would want to answer this is that it depends on how much time you want to spend on your finances. Because, if this is a hobby for you, like you like playing golf, you like playing tennis, so you like managing your money, then you should definitely open a demat account, and you should buy ETFs or stocks, maybe learn about options. So that's a more sophisticated kind of thing. But there is nothing wrong in just buying a mutual fund, or which is an index mutual fund, buying an overnight fund. And at some point, I want to talk a little bit about this concept of safe money. What should you do with safe money? Should you put it in fixed deposits and all? Because I said in my opening thing in that video also that fixed deposits is a disease and there are much better alternatives. So I'll clarify that. But to come to this particular point, which we were talking about, this thing of, mutual funds are pretty good for people who want to not hassle with a demat account and all those kind of things. But if you do mutual funds, you must do only direct mutual funds. You should not do regular mutual funds. And you should not, so if you have a financial advisor, which I would recommend for a lot of people, because you may not want to do this yourself, like you don't manage your own health, you go to a doctor. So if you are not comfortable managing your own thing, then by all means use a financial advisor, but be very careful with what kind of financial advisor you use. And so know that 95% of financial advisors or these PMSs or various things, they do not beat the index. Okay, and that is happening in India as well now. So this was in the US, but increasingly it is exceedingly hard to beat the index. And if your advisor is a fee-based advisor, that's better, because then the incentives could be aligned. I know most people in India are allergic to paying fees for advice because they think they're getting a free deal when their advisor puts them into mutual funds. But that's not the case, especially if you're in regular mutual funds, because you do end up paying a commission. So bottom line, if you just want to not spend too much time thinking about all this, then mutual funds are good. But even if you don't want to spend too much time on this thing, ETFs could be better than mutual funds.
Okay. So the related question is parking funds in mutual funds better than FDs, fixed deposits for short term or medium term?
Yes, absolutely yes. An unqualified yes. Right.
Okay.
So basically I'll explain how. So one is that if you talk about safe money, which you want to keep really, really safe with absolutely zero risk. So the various risks are credit risk, inflation risk, or interest rate risk, and so on and so forth. So like you had in ultra short-term mutual funds, you had this Franklin Templeton thing, which created problems for quite a few people. So that was a thing of credit risk. Now, the longer the duration of your bond funds or debt funds, the more interest rate risk you're going to run. Right. So now if interest rates are going to rise, then these funds will start giving bad returns. When interest rates start falling, you get good returns. Okay. So the key thing to say is, where should I take risk? Right. So if you take risk in equities, according to me, that is the best part to take risk. And your safe money, you want to keep really, really safe. Whatever portion you want to allocate to safe. Okay. Could be 10%, could be 20%. I would not recommend less than 20%. And for a variety of reasons, because you may go down below 20 at various times if there's a market crash, because you want to buy low and sell high. Right? And every time the thing goes high, you should consider rebalancing. That is selling a little bit and increasing your safe money. So the opposite of what everybody tends to do, because they want to, when the market is running up, they want to buy more. And when the market is running down, they're panicking and wanting to sell more. But coming back to this question of safe money. So if you don't take overnight funds, which are the safest money because they invest in what is called reverse repo with Reserve Bank of India, it is as close to zero risk as you can get. It's done daily, so there is absolutely no interest rate risk. And the return can be low when money is flush like now, but money keeps getting tight also. So over time, the returns are not too bad in overnight funds. So that is what I do, but then I use these, like I said, puts and all that, so I get a pretty high return. But so overnight funds is something that you can consider. Then ultra short-term debt funds you can consider. I think Franklin was really an aberration. So if you take ultra short-term debt funds, which are managed by any of the big fund houses. They manage them quite well and very conservatively. So you should be fine. And then there's a third category that some people use, which I don't understand very well. So I'm not personally invested in it, which are arbitrage funds, which are taxation like equity. And, they also are very safe because they operate on the difference between the futures rate and the spot rate, which will always, so it's a cost of carrying kind of thing, and they take advantage of that. So that is where you should park your safe money. And like I said, in equities, if you are not very good at picking your stuff or don't want to do it, you don't want to do options, or you can even do options on index funds. So then you can park things in index funds. So it also might surprise you to realize that, even though I have a fairly large portfolio, both in the US and in India, the number of instruments that I have in my portfolio are probably less than 25. Okay. So keeping it simple is one thing that I always try to work towards. And even those 25, I'm not happy with. I would like to come down to some 10 or 15, instruments, and that's it. Because if you are in an index fund, you're already diversified, right? So why would you want to diversify more?
Okay, I think that question is answered adequately. So now there is a question which probably you can touch on general terms. What is the best mutual fund for 3 to 5 years with a moderate risk? So that really the question is, what kind of mutual fund would be interesting to invest in, where the risk is moderate and therefore the growth is better than what you would expect normally. Maybe it might beat the index.
Yeah, so the interesting thing here is that you want to think in buckets, according to me, right? So if you have your large cap bucket, right? So there you're trying to say that I don't want to take too much risk, and I'm willing to settle for a somewhat lower return. And then you have your mid cap and small cap bucket, right? So there you might want to give a little bit of an allocation into your mid cap and small cap bucket, because say if you take, and I'm just going to mention a few stocks which I own and I know, but please don't go out and buy those stocks, right? Do your own research, right? Because it may not be the right time to buy them. I may have bought them earlier. I may sell them at some point, whatever. But let's take a stock like Deepak Nitrite. Now, I bought this in August because I felt that this company was doing the right things. It was in chemicals. It was going to benefit from Atmanirbhar Bharat, all this kind of stuff. And I listened to the annual reports. I read them. I talked to a lot of people. And I got convinced that it's a good stock to buy and that it may double in 5 years. Okay. So I went and bought that stock. And it has doubled in less than a year. Right now, that's fortunate. And it seems I've still not sold it. So the fact that I bought it, I'm still asking myself the question that will it double in the next 5 years? Because if I don't believe the answer is yes, then I should probably sell it for something that might double. So coming to in terms of the mutual funds, because I've been tracking this for a while, and what I found is that these funds keep changing. So there are, like, there was a fund called Motilal Oswal 35, then there was Axis Blue Chip, and then there was Axis Small and Mid Cap. So Axis at one point was doing phenomenal. I mean, like in terms of a fund house. But then this keeps changing, right? So either the fund managers change or their style doesn't work anymore. And if it changes for a quarter or 2 quarters, it's okay, right? But some of these, like this Motilal Oswal 35, it was like a really high flying fund for 2 years, and then it's been fairly low for the next 3-4 years, right? So if you ask me personally, if I was not picking stocks myself, then I would be in an index fund and not in mutual funds. And I would be in different index funds. So I would be in a Nifty 100 index fund, and I would be in a Nifty mid cap and small cap index fund with some allocation. But I would not be in mutual funds. But that's a personal bias, right? Please don't, I mean, our mutual funds are fine. I don't want the mutual fund people to kill me.
Yes. Yeah, I think that's a fair answer. And maybe the message out there is that evaluate the funds and don't be stuck in it emotionally. Evaluate their performance and over time churn it to better performing funds when you compare on a peer.
Yeah, so a few other things on mutual funds. So one, don't have more than 4 or 5 mutual funds, including tax saver funds, in your portfolio. Tax saver funds, by the way, are very good. So the only mutual funds I have are tax saver funds. So don't have too many mutual funds because there's no point. These are already diversified. So pick a few by doing deep research. And like Avinash said, then keep monitoring them. And keep monitoring them relative to others, relative to the index. And if you think you need to switch, then switch. Don't be emotionally attached.
Okay. The other question related to this is it a right time to enter mutual funds? The answer to that is obvious, but if you can give a reasoned answer as to how people should manage entering into any kind of investment actually.
Yeah, so the cliche answer is that time in the market is more important than market timing. I'm sure you've heard this number of times before. But like some cliches are wrong, some cliches are right. This I happen to think is a right cliche because nobody can predict what the markets are going to do. And I think that's been more evident during this whole COVID time and everything, right? So it's very, very hard to predict what markets are going to do. But if you believe in the general thing that inflation will be there, growth will be there, some stocks will do better than others, then, just staying invested and rebalancing. Now, I just want to spend a few minutes on explaining rebalancing, at least the way I think about it, and I tend to do it. So let's say I have decided that I want 80% of my assets in equities and 20% in what I call safe money. So I start off with that. Now, obviously, in every 6 months or every year, when I look at it, this allocation is going to change. So if equities have done very well, then I might have 85% of my assets in equities and 15% in safe. So then I will rebalance by selling 5% and coming back to 80-20. Now, how frequently you rebalance up to you, but I think rebalancing more than quarterly is kind of foolish. Not rebalancing every day or every month, but quarterly or 6 monthly or annually is good enough to rebalance. And I tried market timing myself. Like I said, I made a lot of mistakes. So even as recently as this COVID thing, in March, I said, look, I think this market's going to fall another 20%. So why don't I sell all my equities and try and pick them up 20% lower, right? So I wasn't panicking. I didn't believe that equities were going to, destruct or anything. But I was just trying to time the market. And that was a disaster, as you well know. Right? So basically, I've now learned my lesson. And I'm saying I'm not going to do any knee-jerk reactions and just, do this systematic rebalancing once in a while.
Yeah, so I think one thought around this is that those who can do it should do a systematic investment plan that on its own, by its very design, averages over time. So it's a good approach to follow in any asset class which is fungible. So now related to this, we are not going to talk about mutual funds again, but there's a question now being asked about allocation. What is the ideal asset allocation for a person who's nearing retirement? Of course, and he's put the FD disorder, equity, private equity, insurance, and real estate. What should be the general approach in managing asset allocation for somebody who's at the peak of their career and are so soon going to retire?
So I'm going to give you a bit of a contrarian view there, because the common wisdom which has been passed down was like the 60-40, right? 60% in equity and 40% in safe. And then there was this other wisdom which people talked about, which was 100 minus your age, right, as your thing. So if I was 64, then 100 minus 64 is 36. So I should have only 36% in equity and 64% in, debt or safe, right? So what has been happening, and I think this is a trend which is going to likely persist, is that the interest rates are low and probably going to remain low for some time. They may go up. I don't think you would get negative interest rates, but they will probably not cross. I'm talking about the US. They will probably not cross 3 or 4% for maybe the next 5-10 years, right? So it's going to be really, really hard to generate income from your safe kind of portfolio, whether that's capital appreciation or actual income. And there is no difference between money, whether it's capital appreciation or it is income. And actually, tax-wise, capital appreciation is better. So you can always sell a little bit if you want, to get cash, right? So, and at some point in time, depending on what your terminal objectives are when you die, you can't take anything with you. So basically, if you want to leave a large corpus, that's up to you. But you definitely want to enjoy life while you can in there. So with that said, according to me, the maximum asset allocation that you can do, not exceeding 80%, to risky assets, is what you should consider doing. And then you should watch it, right? So at some point, I want to tell you how I monitor my wealth and how this has helped train me in dealing with volatility. So if you can deal with volatility and you don't panic, then by all means, keep as high an allocation as 80% to risky assets. And in that, you can keep like maybe 50-60% for relatively safe risky assets, and maybe 15% or something for risky equity assets, and maybe 5% for going to the races, betting on whether India or New Zealand will win the World Test Championship or whatever, whatever gets your fancy, or crypto or whatever, right? Yeah.
Okay, I think that is reasonable. And the related question to this is that, is geographical diversification an essential requirement in today's time, or can somebody who's in India safely just continue to invest in India, or should he look at the global investment opportunities as well if he has the spare investment funds?
Oh, this is a very interesting question, and I'm going to tell you. So I have a reasonable amount invested in Berkshire Hathaway, Warren Buffett's company, right? So I did an analysis from 2004 till now. If I had invested in a reasonably good index fund in India, or a reasonably good mutual fund, and I invested in rupees, so I converted dollars to rupees in 2004, and then converted it back to dollars. So I dealt with the dollar devaluation issue. Then Indian equities beat S&P 500 and Warren Buffett over this period. And the simple reason why is because of the differential growth rates between the US and India. So now the question is, looking forward, what do you think is going to be the growth rate in the US and the growth rate in India, right? And I'm just using US as a geography. It could be China, it could be, wherever you want to invest, right? Geographically diversified. So my sense is that I have not moved my Indian money to the US or my US money to India, just to keep it simple. And I have a certain diversification. So I have like 15% maybe of my portfolio in India and 85% in the US, and so on and so forth. And I don't worry too much about it. And I just try and meet my objectives for wealth creation, which again, I can talk about a little later if there's time. Because setting your objective for wealth creation, I think, is very important in there. So I would tend to feel that there is no great imperative to geographically diversify in India or a believer in the on the other hand, if you want to diversify and invest in diversified assets, then the US is a very good place to do it, because you can buy all kinds of companies there. There are ADRs, there are various things. So it gives you a lot of flexibility. But I would think that you need a minimum of like $5,000 at least, to take care of the transaction costs and, the tax and the hassle. So diversifying with less than that is probably that's in terms of a hedge against problems in India. If you want to move some money regularly to a jurisdiction like the US, you may want to consider doing that. But that's like a hedging strategy against India, where I sometimes, of course, wonder. I mean, I have these gloomy moments when I see what India is doing on pandemic or other things, or pollution in Delhi, for instance, which makes me believe I need a hedge. But that's it. That would be my question. So why you want to diversify? Do significant diversification if you're doing it, but don't just diversify for the sake of diversifying.
Okay, yeah, I think that answers that question, that it is not really necessary to diversify overseas. Do it, but with sufficient amount of money so that it makes sense to manage the fund overseas, right? So now the related question is again about investing specifically in tech equities outside India. Is that a good opportunity if one were to diversify?
Sorry, just repeat that.
Investing in tech companies outside India.
Okay, yeah. So I saw something pop up also talking about FANG investments and all those kind of things, like the Facebook, Amazon, Netflix, Google kind of thing. And, so one is like you feel good. I own a piece of Facebook, I own a piece of Google, or whatever. So I'm removing that emotional side aside. And clearly FANG have given some great returns, and the tech story is going to continue, right, in there. So personally, what I have done is that I have a substantial investment not in FANG, but I have an investment. I continue to have an investment in PayPal because I understand the company, blah, blah, blah. I have this investment in Warren Buffett's thing. But I also have a substantial investment in semiconductor stocks. And there I have an investment not in NVIDIA or things like that, but I have an investment in something like TSM, which is a fab, which makes semiconductors. And then I have an investment in the tool companies, which provide tools and machinery to these fabs. So a company like ASML or LRCX. Then I have another investment in solar, and I have an investment in this data cloud kind of companies, because I think that these are themes that I like, and I find those are not available to me in India. I mean, like if I wanted to invest in data cloud in India, there isn't a single company where I can invest, right? So I have to invest overseas. Same way with semiconductors. There's nothing in India that you can invest in. Solar also, there is not a significant one. I'm not a big fan of the Adani group, so I'm not into Adani Green or anything like that. So I find better investments there. On the other hand,
cybersecurity. There are no cybersecurity companies listed in India, and it's a very fast-growing field.
Yes. So cybersecurity is another area that I do have some investments in, and there also the but there are a few Indian companies. Like I have an investment in a company called Affle, which is a very interesting company in India, which is trying to do something in advertising. So it's not all that, and I also believe that chemicals and specialty chemicals and CMO and CDMO and all that kind of stuff in India might be emerging fields, just like software was an emerging field in India many years ago. So gems and jewelry was an engine of growth. Similarly, chemicals, specialty chemicals, this whole pharma things, CDMO, CRMO, etc., may be engines of growth. So I tend to look for those kind of things, and then I then try to find the stocks that make sense to me in those industries.
See, the fact then still will remain that whenever you're looking at tech, these are basically new companies, startups, or fast-growing startups who are now gone into a growth phase. The amount of funds you allocate for such investments will always be a small proportion of your investment, which is earning you more steady returns.
Yeah, so Avinash, you make an interesting point, but so some people use what I call the spray and pray approach. They say thoda thoda idhar dal do, thoda udhar dal do, kuch na kuch to padega, theek hai, right? I am very different in that. I try to research the companies I invest in a lot, and then I put a sizable amount, and sometimes I'm wrong, right? And then I monitor. So this monitoring point, Avinash, is this a good point to talk about it?
Because yes, please go ahead. Please go ahead, because it is related to this.
Okay, so on monitoring, this is, I think, one of the things I'm most happy about, and I started this very recently. I started doing this in August of last 2020. So I said you have all this index like Nifty, Sensex, Dow Jones, S&P, Russell 2000, whatever, right? So I said, why can't I construct my own index for my own wealth, right? And I'll keep it very simple because I don't want to go and value a car and value a painting and all this kind of stuff. So forget all that, right? So I'm just going to take my Indian brokerage account, which is with Zerodha, and my US brokerage account, which is with Fidelity, right? And I'm going to convert the Zerodha account to dollars. Because I still think in dollars, right? And that's my base currency. Okay, so now it's a very simple exercise. I can take this value of my account and I say this is my wealth index. Okay, so as on August 1, I put that as 100 as my wealth index.
That's probably 2020, right?
August 1, 2020. And I set myself a goal. Now, what was the goal that I set? I said that I want to double my wealth every 5 years. And why? Because by the time I'm 75, if I get there, then I want to give a lot back to society. So a fairly large number. And in the middle, I'm not giving anything because, I find it very difficult to, so I have something in mind where I want to create a foundation with like-minded people, etc. So I have a purpose, right, as to why I'm creating wealth, because otherwise, you have to ask yourself a question after a certain point saying, why do you need more wealth in there? So I said, I want to double it after living expenses and taxes. Okay, so that to me seemed like a very ambitious goal, and it's still a very ambitious goal because it requires a 15% CAGR after living expenses and taxes. Okay. So I said that this number in August 25 should be 200, right? And I can straight line it for the 60 months in between to see how am I doing relative to the to my goal. Now, just now I've been through a very fortunate period in August now, like, because everything is up, right? So obviously I'm also up. So my index is about 134. But the thing I'm happy about is because I'm monitoring it relative to the index, and I have a blended index for India. So India is fantastically up in dollar terms since August, if you compare it to the S&P. Okay, so the Indian index is higher than this. I'm not beating the Indian index on a pure basis. But on a blended basis, I'm beating the index by about 4 or 5%. So whatever I'm doing, this keeps me honest, because if at some point in time, and I can monitor this almost easily every week, because it's so simple. I mean, I haven't written a program for this, but I can do it, and it'll just spit it out, but it's like 10 minutes of calculation or whatever. And it keeps me honest, in terms of that. So if I end up saying that, hey, I'm not beating the index, and why am I doing all this nonsense, this cash covered puts, covered calls, this, that, and the other, picking stocks, trying to say, semiconductors are going to do well, or this is going to do well, listening to all these transcripts, trying to do all this. I'm just might put stuff in the index and enjoy life. Why bother? Just rebalance once in a while.
Yeah, so I guess the very important lesson is that at some point you have to be benchmarking your investment performance with something which everyone else is looking at, or it is a benchmark which is definitely performing well.
Yeah, so I've seen a lot of people who have no idea how much their wealth is. And I don't know, maybe this is some kind of feeling of stigma or something, that I shouldn't know what my wealth is. Because if I know it, then maybe I'll spend more or whatever I'll do. I don't know what the reason is. But people don't know that. And at least like in my father-in-law's case and my father's case, when they passed away, we had a fair amount of difficulty because, they forgot to tell us about certain things and we found them out later. And, it was a real pain. So, just simplifying all the time, having a will, doing your housekeeping, not getting too complicated, and I think this COVID has taught us that, life can be very fleeting. You're fine, and you could be young, you could be old, you could be, the best of health, and something like COVID can get you. So I think this whole business of monitoring, if there's one thing that you take away from this session, please take this away. Please know what your wealth is, monitor it, do the housekeeping. It's critical. You will enjoy it. And on this monitoring point, one of the other things that I tended to realize was that my wealth fluctuated so much, right? That now if I have to spend, right, like let's say I have to spend 2 lakhs for a month to rent some place in Mumbai or whatever, an Airbnb, something, I don't think twice about it, because my wealth fluctuates so much, right, that these kind of things are noise, So the numbers may be different for different people depending on their wealth, but the ability to deal with volatility, not get exuberant when your wealth increases massively, not get despondent when your wealth drops massively, and to say like, okay, I can afford to spend this. Because for the longest time, I would not fly business class when I went to the US. I said, it's a waste, right? But then I said, what am I doing, right? Why am I not flying business class, right? In there, because I have the wealth, right? So if some may consider it wasteful expenditure, but why did I create this wealth?
Okay,
So I don't blow it, but yeah.
So the message is very much that while you monitor wealth, you should also spend it on yourself, like you mentioned in the video, for your own well-being, without getting extravagant. Now, there's a more brass tacks question, which is asked by Kamlesh. He says that my target was 8% return in the past year. In past 6 months, invested only 50%, and I'm up by 20%. 50% I have in cash. Question is, should I rebalance and invest the rest of 50% at one go, or do a SIP?
Yeah, so I think, that is really like an individual question. I mean, like you have to decide. But I think, breaking it up into a few blocks may not be a bad idea. But I think, if you convince yourself that, look, I need to have an asset allocation of like 80% in equity, 20% in safe, whatever you decide, then how to get there and how many steps, et cetera, is something that you have to decide. And, it's not an irreversible decision, right? Because who's to say that 10 years from now or 5 years from now, the situation may not change drastically, right? So, you have to react to change. You can't be saying, okay, I'm just going to do this. Or I'm never going to change from 80-20 or whatever. But right now, it looks like, see, because the problem is that if you go back to my first slide, in the 6-minute video, the real rate of return and how much the compounding effect causes. So the minute you missed out on an opportunity of, like, suppose you got an 8% return or a 15% return or a 20% return in this last 1 year. Now that you may be very happy with, but it's actually a suboptimal return, right? And that difference of 34% and 20% of 70% and 20% is quite significant, and now it can also be the reverse, right? You could lose a lot. So you have to think about it, and do what you are comfortable about it. I can only tell you that just spend time thinking about it, and because it's one of the most important decisions you will make regarding your wealth, your asset allocation.
So I think the answer really lies in the question of the asset allocation between risky and safe assets. Keep that focus and distribute the money either progressively or in relatively short steps to maintain that ratio, or switch to a new ratio that you are comfortable with. That is probably the best answer for this question. More simpler question was that currently the Sensex has crossed 50K, and is it a good time for someone who's not in the equity segment in terms of investment? Can they start investing now, or is it too high a risk?
Okay, this is a very interesting question, right? So I talked about Deepak Nitrite, right, where I bought it and it's doubled, right? So now the fact that I bought it and it's doubled is history, right? So the fact that I have not sold today means that I've bought it at today's price, right? Now, this is something that, again, people don't understand, right? Because the fact that I have a fair amount of investment in the Sensex or Sensex equities or equities in general today means I've bought the Sensex today, right? So how can it be a bad time to buy, right? It's never a good time. It's never a bad time. It's just a time when, so what is a good question to ask is this the right time to rebalance, right? And I would say yes, if this is because you would be selling a small part of your holding at a high price, right? And then you can wait to invest that at a low price, right? But if your decision is that I want to move to an 80-20 asset allocation, then whether you do it now or you do it 6 months later or 12 months later, it doesn't matter, because at some point in time, you're in the market, right? And then it's going up and down, up and down, up and down. Yes.
Okay.
Now, if you could time your entry exactly, it would be great. But once you're in, right? So maybe you do it in 5 or 6 chunks. I'm impatient. Once I decide something, I will do it in 2 or 3 chunks, not more than that.
Okay, so the answer again remains that decide your asset allocation ratio and move towards it in a time frame which you are comfortable with. That's really the answer. So you can.
And just remember that every day you're not selling, you're buying. So what price you bought it at is absolutely irrelevant.
Right. Okay.
Except for tax reasons. That's
okay. So there's another question from Shravana. How does one plan a continuous income based on monthly expenses without a salary, but sources of income are stocks, real estate, and cash savings? Say we have a monthly expense of rupees 70,000. I think it is partly already answered in what you said, but you can touch on it again.
Okay, yeah. So what I'm saying, I'll tell you exactly what I do, right? So I have a certain amount of cash in my Zerodha account, which is basically in liquid Ds. So it's these overnight funds, basically. So it's an ETF which invests in overnight funds. So at any point I can liquidate that and I get cash, and then the cash is in my account in a couple of days, right? So basically I use this whenever I need cash. So if my savings account is running low, I have a credit card bill coming up or some monthly expenses or whatever, I just take money from there and put it there, right? I don't try and generate dividend income or option income or anything, to match my spending, because my spending tends to be very lumpy. And, whenever I need money, I just take it out from my corpus, because I treat my corpus as fungible, and it has enough liquidity in the corpus that I'm not selling equities. Because the problem of selling equities is that if you're selling equities at a bad time, when the market has crashed, you can lose significant amounts of money. If you're selling for rebalancing, it just buffers up your cash. So I don't know if I've answered that question, but you are basically using your corpus to meet your monthly expenses. So it's like you work in a while for a while. Once you've achieved financial independence, retire, your money works for you.
Okay, all right, great. I think that probably is a good answer. Now I'll ask several questions in one shot, which is talking about the total new generation, Bitcoin and other cryptos as possible investment opportunities on one side, and that's stayed old yellow metal. Does that make sense? So between gold, cryptos, and other new generation investments, what would your views be on how to handle investment direction?
So I think in my mind right now, it's fairly clear that there is going to be commodity inflation of all types, right? Now, I have not been personally looking for a commodity ETF, which I could invest in. And the simple reason for that is that in my scheme, these covered options and cash covered puts and covered calls generates enough income for me. So I'm not really looking that will, because that is a play on volatility, and volatility will happen whether the markets go up or down. I'm going to get that income, and I kind of understand it well, right? So for me, this is not personally a very relevant question, but for someone else, if they want to have a certain allocation to commodities, whether it be gold or other commodities, it may be a good thing to do. I don't know commodities that well and how they work in India, etc., etc. So that's something that you'll have to figure out. But commodities as a hedge right now seem like a good thing in them. Now, as far as Bitcoin, I actually studied this extensively because for quite long, I did not do anything in Bitcoin because I just didn't understand it and I didn't want to waste bandwidth. I didn't, whatever. But then when PayPal started offering Bitcoin, and I read a little bit about the regulations and all that. So then I said, hey, this thing may be becoming mainstream. So I decided to invest in Bitcoin, but not in Bitcoin directly. But I bought a stock, which was the stock called MSTR, MicroStrategy, in the US, which is essentially a Bitcoin proxy, right? So I didn't have to deal with all the hassles of regulation and, can I buy Bitcoin and how do I store it in my wallet and, whatever else, all those kind of complications. And what happens if I die and my wife doesn't understand where my Bitcoin is, and whatever, So I found this proxy, MSTR, and I invested in that. And I made a fabulous return, I didn't invest a whole lot, but I invested a decent amount and I made a fabulous return. And then I got out of it. Now, the reason I got out of it was, again, it looked to me that there were all these concerns being raised about green Bitcoin and all this kind of stuff and things. And so I invested in Bitcoin because I read a book on Bitcoin called The Bitcoin Standard, which is an amazing book. So it talks about sound money and how Bitcoin is sound money and how sound money is very good for the world and blah, blah, blah. So I got influenced by that. But then I felt that these arguments were not making sense anymore. The regulatory framework was not very supportive and that this Bitcoin would take time, right? So I said, okay, I'm not into this for speculation. So I got out. I may get in at some point, but all these things like NFTs, altcoins, Cardano, Ethereum. So I spent a fair amount of time studying Ethereum. I don't know that much about Cardano and all that. And then there are all these Doge coins and various things, whatever. So my general rule is I don't invest in anything I don't understand. Reasonably well, right? I can't this thing. So I will stay away. But the guys who figured the next big thing was going to be crypto early on have made huge amounts of money. So when I joined PayPal, for instance, when I talked to my friends, they told me what a big mistake I was making. But I believed, right? And I made a shitload of money on, right? So, I don't know, right? Like, just the thing was that in each of these cases, at least for me, I believed because I'd done my homework, right? Yeah. And I didn't trust a third party or a mentor or somebody, to guide me, So I think these very risky things, just going with the herd is a risky thing because you might be left holding the bag at the top.
Okay, so the answer is very short and simple, that the cryptocurrencies at present are a very speculative asset which have a very diffused kind of regulatory framework or none at all, and therefore it would be really a very high risk extreme asset in which you should exercise caution until things are more stable and there is a perspective.
And if you want to do it with a small amount of your money. Don't go all in on crypto. It's like crazy if you do it, according to me, right? Because who knows, you may lose all your money, and that's not something you want to do.
Okay, so now for this question, which is more focused to the younger generation. There are a couple of questions we shall ask them both together. What is the method for long-term wealth generation, especially if one has just started in one's mid-30s? As a young private employee, how to plan for future children's education. And there was a third question which was also asked, is that on a transferable job, should I invest in real estate at all? I think that question is reasonably well answered, that if you have the right kind of asset mix, you don't really need to buy real estate as a option, because its return on investment is not so comparable to the equity market. But focusing to the younger generation, how would you suggest that they should look at growing their wealth after seeing what you have done for yourself?
So, I've had the advantage of working with very large companies and then working in a startup, and then being involved with a lot of startups. So there is no one right answer for everyone, right? But if you think you're a startup type of person, or you can run your own business, or you do your own startup, or whatever, your own restaurant, your own this thing, whatever, you have that kind of mindset, then I think there is a lot of data to show that the kind of wealth you can create with your own business, you will probably not be able to create working for someone, unless you end up becoming a CEO in a very large company and you get paid huge sums of money, etc. Right? But some people who are huge CEOs in huge companies would be disasters in startups. And some people in startups can never become CEOs of huge companies. Right? So you have to know yourself. And this, in that first 6 minutes, the last thing I said was invest in yourself. And if you want to invest in yourself, learning, spending a lot of time looking around in the world, trying to understand, and especially if you're a couple, maybe one person is more oriented towards a steady job and one person is more risk-taking. And that doesn't have to be, the risk-taker doesn't have to be a man. It could be the woman, who's the more risk-taker. So I think that's the thing. But these days, again, I'm biased, so please take this with a pinch of salt. But I see so much change happening. If you look at my LinkedIn profile, I call myself a disruptive innovation evangelist. So disruptive innovation means there's a lot of wealth to be created. And if you can participate in that, you will end up creating huge amounts of wealth, right? But if you go and work in a government job or, a salaried job, with HDFC Bank or something like that, which is what I did till I was 40 with Citibank, then that may be suboptimal, for a lot of people, but it may not be suboptimal for some, right? So I can't give you one concrete answer, but I think the one concrete answer that I can give you is that with all these things which are available on Coursera, this, that, and the other, if you can develop a joy for learning, a true joy, because when you are young, you are forced to learn, right? But here, I get true joy from learning. And if you look at my LinkedIn profile, I think in the last year, I've got 3 certifications or something which I paid for, right? And why did I pay? Because I thought the courses were fabulous and I thought it would be very cheap of me not to pay. When I could afford to pay, it would be like going to a good restaurant and not leaving a tip. So I didn't want to be a cheapskate, so I paid. And I took those courses. I don't think those courses are going to help me, get a job. I don't need a job anymore. But they have helped me immensely for my emotional well-being. And now, I can talk about Python. I can talk about Google Cloud Computing. I can, understand how Gmail works, and so on. And why do I need to know this? I don't know. I just want to know because I love to learn.
Okay, so I think that's a very good answer, and I'll just supplement with by just speaking from your own experiences that if you're in a corporate job or in a steady job, you should always have a plan B for your managing yourself should you not have that job anymore. And like yourself, you at 42, you had a corpus available to do many other things. That's a goal which some people working in jobs should have, where they can create a corpus which can give them options to do something else, either into investing into a different kind of activity which gives a multiplier in growth, or having investments on the side, which you already talked about in terms of the high risk and the safe investments. So there are options which are available. Now, there's one question which somebody has asked, is that I have not really done much savings in life, as most of the savings have gone into house EMI, investment in shares, not yielded much returns, and one is on verge of retirement. What should somebody do in such cases for survival? This is a very interesting question. There will be a lot of people in that boat who have not really
well, then now they've reached retirement age, kind of thing, right?
Yes.
Yeah. So again, there are several options to look at, right, in terms of restructuring what you're doing. So one of the things which is popular in the US, maybe not so popular here, not even that popular in the US, is this thing called reverse mortgages and stuff like that. But the thing is that if you only have one home, which is your primary home, people are extremely reluctant, and rightly so, because everything is not about investing. There is a lot of emotional stuff. Like if it was all about investing, probably people would not have kids. Pretty bad investment in most cases. But and not an investment really, but it's an emotional thing, right? You want to do it because you want to do it, right? And it's something that you want to do. But one of the things that a lot of people can consider is getting rid of any investment properties they have, even the property that they live in. Because again, I'm going to tell you from a US perspective that in the US, people start off in an apartment. Then they buy a house. Then they buy a bigger house. And then they sell that big house and go back into an apartment or a senior facility, right, in there. So that is the chain. So what happens is that if you have a house, and that is a very substantial part of your net worth, you cannot eat that house, right? You cannot enjoy yourself, right? You can, and later on, I've also seen a lot of complications with immovable property on how you pass it on to the next generation. There are fights, there are hassles. There could be people like my brother lives in the US, I live here. My dad had a place in Pune. I was living in Delhi. Now we had to sell it, right? And we did, but it was complicated, in terms of that. So I think one of the things that people can look at is that they can get out of fixed deposits if they have fixed deposits. They can get into getting the right kind of asset allocation, and come to peace with volatility. A lot of people have gratuity, superannuation, PPF, etc. So like I could never convince my father to get out of PPF because he said PPF is golden, right? But if you do the math and you look at this very dispassionately, look at indexes, look at this, and of course the past does not predict the future, but you can try and see what was the underlying thing in the past, right? So this is a very interesting question, and it may be good for a person to work with a good advisor, who can help them, and probably an advisor who charges a reasonable fee, and not somebody who will put you in the wrong kind of investments. So that would be my.
Okay, so basically your message is that there is opportunity perhaps to rebalance your asset portfolio, including the properties that you're holding, so to make life a little bit more easier for you in your golden years.
Yeah, and this is not easy, because people worry about rent karenge, then we'll have to keep moving, we'll get kicked out, will we be able to get a long-term lease, and so on. So I've dealt with a lot of this, and for my father, we actually rented a place in Delhi and Sombihar on a 3-year lease, with very favorable terms, where we could cancel after 11 months, only if my father passed away, but the landlord couldn't cancel. And there are people looking for these kind of things, landlords. So you can always negotiate. You can find things.
Okay,
yeah.
So we are close to the end of our session. It's already 7:30, but there are two questions I would like you to answer. One is a question related to investor who has got investments across the asset classes. Would you suggest any tool, product, framework which would help track all the asset classes that one has? And currently, whatever is available has limited coverage, and it's probably linked to commercial links of the underlying sponsor of that particular tool. So, are there any generic tools which you would suggest which can be good for use by anybody who wants to monitor their wealth?
Yeah, so I have focused on stocks. So there are many tools, like there's a company called Trendline, there's something called Ticker Tape, etc., which gets you lots of data, etc., that you can look at. All right. I don't know that much about other asset classes like real estate and commodities and blah blah blah. But the thing is that everything can be broken into cash flows and returns and risk. So this whole business of being very simple. And by being very simple, I'm not talking about being very simple only in equities. Like, let's say you understand real estate really well, right? Like you are a master at that. Then just stick to real estate, right? You know how to buy, sell, do whatever, refurbish it. If you understand commodities very well, or you understand foreign exchange trading, or you understand trading very well, just do that. I just feel that, you can't be a specialist in too many things, right? So just find whatever you want, and then those things are deep enough for you, not, in my opinion, to diversify across many different asset classes, because diversification is not a goal, right? It's it just, for some people, it makes them emotionally happy that I'm diversified, right? And I'm following what gurus are saying, right? It should be diversified.
Okay, so that's a very good answer. That is okay. Simplify your life. Don't dabble in everything under the sun where you think you can make some money, because then you'll be a jack of all trades but specialist in none. So the focus is.
So I think we are to the last question right now.
Yes, they're very much the last question. The thing is about what's your opinion on life insurance, and is it a risk management tool which one should consider? Enough has been said about it in terms of not being a savings tool, so I will not even suggest that. So, is it a good risk management tool, or there are other options one may consider?
Yeah. So first of all, in life insurance, one should only go for term insurance, which you've already covered, right? So that it's not an investment tool, and it's just like if you take fire insurance, if there's no fire, you don't get anything back. So similarly, in life insurance, if the term expires, you don't get anything back, right? That's the insurance you should take. Now, the question of whether you should take that insurance or self-insure really depends on your situation, right? So, for instance, when I left Citibank, because PayPal and all, being a startup, didn't have very good insurance policies. And I was thinking I was taking a good risk, and term insurance was very cheap in the US. I took some fairly big insurance policies till the age of 50. Because I felt by 50, I'll have figured all this out, right? So the normal thing was 60, but I said, no, by 50, I'm done. I had only one son, he would have been in college, whatever. So it's that thing that you kind of make this decision on insurance, looking at the rates, looking at the risk that you want to cover, and always ask the question that should I self-insure or should I buy insurance, right? For those of you who are gamblers, if you play blackjack, then you know when to buy insurance or not, right? Is 21 going to come or not, right? So it's very much like that with insurance, right? So whether it's motor insurance, so I can very quickly tell you about one of the things that I've done is that I have now only one car. And I don't have a comprehensive policy on that because I realize that I don't drive all that much. My driver is very good, and I live in a very safe place, so there's no point on a risk perspective to buy comprehensive. So I have only the liability insurance, and I save some 15,000-20,000 rupees a year just doing that, making that decision because it made sense. Similarly, on health insurance, I don't have a family floater plan because I can afford to self-insure up to 5 lakhs. But I do have a top-up plan, right, up to 25 lakhs. Again, the premium is very low, right? I think for the two of us, my wife and me, it's something like 18,000 or 20,000 rupees on the top-up plan with no room limits and all that, and it's up to 25 lakhs of insurance. So everything, you can study, right? Like try and figure out if you have the interest, talk to people who might help you, but then do your own research. And that would be, I guess, the last message that I want to leave you with.
Yeah, I think, we may have the floor open for 2 open questions before we wind the session down. And if you raise your hands, then I will pick you up and ask you to ask a question. Anybody who wants to ask a specific question which we have not really covered, please raise your hand. Okay, so Sanjay has raised a hand. You can please go ahead, ask your question.
Hi, Mr. Bhargava. My name is Sanjay Rajpal. I'm from Mumbai. Regarding these mutual funds and the debt funds or whatever you're talking about, the others, what is the view on this Bharat Yojana funds, the ETF? I think your phone is on, you're on mute.
And you're on mute. Yeah. Okay, yeah. So this is the 22 PSUs, that ETF, is it?
Right.
Yeah. Okay. So, I have not studied it in detail, but, in general, the thing is that with the divestment going on and everything, and, this thing, it may be a good investment, but I have not really looked at it from that point of view. I just, because I've seen how PSUs work, I kind of have an aversion to that. So I just stay away from the whole PSU.
It's got a AAA rating.
Okay.
Government securities got AAA rating. And one last question is, do you advise putting money in the China mutual funds?
Yeah, so I personally have a small investment to Alibaba, even though because it got beaten down a lot after this Jack Ma thing. And I looked at Alibaba and I found that it has investments in so many properties and this Ant Financial and everything is so good that I decided to do a small investment in that, and I probably want to raise it. So this is my contrarian bet, but I don't want to do it in China in general. I like to be more specific if I can do that.
So thank you.
I think I'll just add to that is that whatever you're investing, if you're doing it the first time, pace your investments and study the results and then look at expanding if you're going to do it. Don't put all your assets, all your money into
that's very
one
good
basket.
Point. That's exactly what I do. I put in something so that I have some skin in the game that I keep watching, and then I add and add and add. Yeah.
Okay. The very, very last question, open question which has come in. What's your advice for startup guys like me? This is one of my friends, Pradeep, who's made a product as part of a startup which he's trying to market. So he's asking, what's your advice for startups like myself, since you have also started in a startup like PayPal?
Yeah, so I think this is a very tough question to answer without knowing a lot about the situation. But the thing is that, if you really believe in your startup, which most people do because they drink their own Kool-Aid, right? So I've yet to meet a startup person who doesn't think that their startup is going to be God's gift to mankind or whatever. But, the thing is one has to be realistic, right? So the stuff is that when you give away equity in your startup to whoever, whether it's an institutional investor, etc., you may believe that that equity is very valuable, but that brings some benefit to it. You get a salary, etc., etc. So, if you have a fair amount of risk in your own startup, then I would tend to not take risk in other investments, right? Like I won't go and do startup as well as Bitcoin if my startup is not Bitcoin, right? Because I don't want to be crazy about risk, right? Taking risk everywhere. So I want to have some solid stuff. So I may, still, depending on my overall situation, depending on whether I have a spouse or not, what is the situation, do I have optionality, do I have wealth, etc., etc. Those would decide your asset allocation that you want to do. But the answer is pretty much the same. And the last thing is that I would say, at least I did this, but I would always give myself some very concrete goals, where I would say, look, I'm not going to keep thinking that my startup is going to succeed if the market is going to tell me everything the wrong way, So if I can cut my burn rate in the startup such that I lengthen my runway for the startup, then I'll continue. But if I have to call it quits, I will call it quits.
Okay.
Right?
Would you have specific pointers? Pradeep is actually in a product startup, software product startup. What tips will you give to him to maybe establish himself from a marketing perspective? I think he can have a conversation with you later on, but just in very general terms, what would you say a product startup should do?
No, so, I actually happened to be leading product in PayPal when I was there. So I'm like a product guy. But the main thing that which made a company like PayPal successful was we were obsessive about looking at our competition, looking at our product, trying to learn from everywhere, not being arrogant. So in my team, we studied 70 competitors. Okay, and some of these were not competitors. You say, "What? I mean, how is this company a competitor to PayPal?" But we would consider it a competitor, and we would try and learn from everybody, right? Like, okay, this person is doing this well, this person is doing that well, whatever, right? So that kind of thing, and then it's all about selling, right? So if you are able to convince your investors, convince your market, it may be a B2B, it may be a B2C, how you convince people who are going to join your team, there are lots of variables. But again, what I have said is that if there are people who want to build startups which are going to change the world, and why can't they come out of India? Then I've said I can be a coach, but then I have a very stiff entry barrier for people to come through, which is that they have to do this course on a paid basis from Harvard called Entrepreneurship in Emerging Economies. And it costs about 15,000 rupees. They have to complete that course and then feel it's worth it. And feel that I might be the kind of coach who might be able to help them. I will not invest in startups because that does not fit in with my investment strategy at this point. So that's, I think, the specific stuff.
Okay, I think that's a fairly comprehensive answer, and maybe offline I will discuss with him, and then, if appropriate, connect him with you to get a little bit more specific on advice. But yeah, it has been a really interesting evening. I think we have covered everything under the sun, but let me just say that this is not a financial management program. The intention was never that. It was just to give clarity to a lot of people as to how they should go about creating wealth in bits and pieces. And I think one of the messages which is there is that keep life simple, don't complicate it by spreading your energy and your wealth or your investments all over the place. Keep it focused and have some sound objectives, and always measure and benchmark your performance versus other opportunities that might be there. So,
Avinash, can I just add one thing?
yes,
Sanjay.
of course. Yes, Anita, please go ahead.
You know, having examined a lot of portfolios, only 11% of the people consistently beat index funds. Okay, they can be doing whatever they want from wherever they, you know, whatever advice they come from. So what I would recommend to people is please compare yourself with index funds.
Yeah, I think that's a very good point. The index is.
I would just like to thank everyone. I hope I didn't bore you all. It's a very long session. The very last thing I want to say is that, you know, prosperity is not wealth. Prosperity is health, your mind, most importantly, your mind. And if your mind is correct, then wealth is easy, right? So please do invest in your mind first, health second, and wealth will be a byproduct. You know,